Welcome to the Vaughan Nelson podcast. With me today is CEO and CIO Chris Wallis. Welcome, Chris.
It's great to be here, Dan.
All right, Chris. First macro podcast of the year here in 2026, and seemingly good amount to talk about. We finally have Trump's pick for the federal chair. We're seeing that with Kevin Warsh. We're seeing some of the market narrative that's looking like Mr. Warsh is a more hawkish pick. He was never quite a fan of QE. He seems to have a strong desire to shrink the Federal Reserve's balance sheet. What's your view of Kevin Warsh, and do you think this pick eliminates the fear of the Federal Reserve losing its independence?
Yeah, so let me separate it into two pieces. One, let's talk about the Fed's independence, and let's talk about Kevin Warsh as Fed chairman. The Fed is not independent. They've never been independent. When somebody starts writing about the Fed losing its independence, it's a canard. Just ignore it. They're all politically appointed. Um, they're all beholden to their member banks. Even their mandate, while it's used to drive the narrative of independence, they only care about inflation and employment as it relates to its impact on the member banks and capital markets and the ability of the government to fund itself at at a cost of capital that's affordable. That's it. They do not care if your eggs go up. They do not care if your housing becomes unaffordable. And they've demonstrated that through all of their policy actions. I think Greenspan, kind of roped independence and hogtied it. And then I think Bernanke and Yellen put it on an altar and set it on fire and sacrificed it. And what I mean by that is they gave up any policy flexibility with the policies they chose post the financial crisis. So all we're trying to do is do some form of renormalization. Then if you go back and look at the entire history of central banks, ours included as well as others, there are decades when all the central banks do is financial repression to support deficit spending at the federal level or to support industrial policy at the behest of a central authority, whether it's a federal government or whatever that may be. So feds are never independent. Let's just acknowledge that. So we just need to understand the policy paths that they have in front of them, look at what they choose, and then accept the economic consequences of that and what that means to capital flows, cost of capital, and who benefits and who is hurt by that. So that's kind of the framework that we're going to use. You know, Kevin Warsh made a lot of comments pre financial crisis, and during the financial crisis, it would say he's hawkish. But what he said wasn't unusual at the time, which is, hey, QE could be inflationary. It depends, right? It depends on what the Fed does with the reserves, how they manage the ballooning of the reserves in the financial system. And clearly, the QE that we experienced over that period of time was not inflationary. So you can say, oh, he's going to be more hawkish. The guy worked for Druckenmiller. He's married into a billionaire family. He's good friends with Bassett. The idea that this guy isn't an insider and isn't going to be supportive of capital markets is crazy. There's no question that I think he'll cut rates because they should cut rates. I know he's talked a lot about shrinking the balance sheet. I think that's a nice to say, but it's like everything. When you're outside of the position, you can critique it. Once you get in the position, shrinking the balance sheet isn't easy. It's easy to pick what assets you want to get rid of, but okay, what liabilities are going to go with them? So it's going to be very conditional, dependent on whether or not the Fed will be able to shrink their balance sheet. And there's ways it can be done that's kind of net neutral to risk assets at best, but by and large, it creates turbulence within financial markets for the Fed, given where we are today, to kind of shrink its balance sheet. So I would kind of ignore that side of it. I don't think there's any question that they want to shift power away from the Fed and towards the Treasury. And that's not necessarily a bad thing. The question is, how would they do that? So I do think Kevin Warsh's appointment is going to have more coordination between the Fed and the Treasury. And quite frankly, that should be welcome given the challenges we face, given the amount we need to spend, and given the current deficits. And I think they'll do it in as benign a way as possible. It doesn't mean it has to be as supportive as they have been historically for financial markets. But his appointment isn't raising any concern for me. I mean, we're in a tough spot. We all know it. There's going to be some collateral damage and there's going to be some collateral opportunities no matter what policy choices we make from here.
All right, and then thinking more about what's taken place in the market recently, right? We're about first week here of February. Year to date, we've seen a continued market rotation. Some of the previous leaders in the Mag 7, they've really broken down, and we've seen a strong rotation into U.S. small, U.S. mid on the domestic side, and then as we've seen continued strength in the equity markets outside of the U.S. Do you believe that these moves are they're sustainable? Are they driven by earnings, fundamentals, or is this just a big AI disruption fear that's causing a bit of a temporary repositioning?
Yeah, look, I think it's fundamentally driven, and it's not new. It's just coming to a crescendo where people are watching their largest holdings, whether they own a passive index in the form of the triple Q or the S&P 500. But we saw the broadening of stock performance last year. We saw emerging markets outperform the S&P. Foreign domestic performance outperformed the S&P. We saw broadening and strong performance in the back half out of the year out of small caps, out of micro caps, out of regional banks. All of that is indicative of exactly what we said we're going to see, which is we're going to see an improvement in economic activity. And now we're getting confirmation that we're probably going to see much higher ISM figures out of the United States. And we're seeing it in Q4 earnings releases where small cap earnings are growing, mid to high teens, if not going to be in the low 20%. So we're leaving an environment where the Mag 7 dominated because of flows, and those flows were driven by one, people seeking growth, and growth was limited in the equity markets globally. So it crowded money into the US and it crowded money into the S&P 500 that was, dominated by tech. Now we're seeing growth broaden because we're seeing populist policies developed around the world. Those aren't going to stop. So those policies are going to continue to drive growth in other areas in the market. And everybody was way over positioned into US dollar risk assets and into US large cap tech. And so if they want to go buy those other things, they have to sell what they own in order to do that. And so that creates these rotations. Look, I think it's going to stay in place through the first half of this year. We've already seen a significant rotation. So I'm not here to say that, it's going to continue at the same rate that it has the last 3 or 4 months, but it certainly could. Once we get past the second quarter, it's really going to depend on a couple of things. Where are we with the policy implementation? Where are we with the Treasury's going to increase the TGA account over the next couple of months? That's going to be liquidity negative for markets, and then they're going to run it into the economy, and that's going to flow through capital markets and flow through the economy. If we get enough traction and we get enough growth outside of the US, then we can continue this well through 2026. Um, but there's no question that the US, Europe, is making the decision to pursue more fiscally driven, fiscally supported uh, growth initiatives because they need to, right? There's a lot of poor policy choices that are being reversed. At the same time, we're going to go through kind of a normal energy cycle as well because of underinvestment. And so we're going to see capital move out of other areas of the world into energy capex. And that also kind of drives cyclical recoveries, industrial activity, and a broadening of growth. So all of these things are very normal. They should be expected. And they just happen to be happening at a time when, yeah, there's some disruption that's happening from AI. The amount of spending that's happening by some of the incumbents in order to protect their market share is getting excessive. And so there's reasons for concern over the intermediate term, whether all those fears manifest themselves over the next 3 to 5 years, yet to be seen. But people, for the most part, only own those shares because they were going up. Now the narrative's being called into question and they're seeing earnings growth and better performance elsewhere. And let's face it, people, they're like lemmings. They're going to chase performance. So I do think it's more than a little bit of a head fake. I do think it's policy driven. I think it's driven by capital flows, capital cycle. The U.S. is starting to cut rates. We may see Japan and others raise rates. So to the extent capital flooded into the U.S., it's going to go elsewhere. Again, they have to sell what they own, which for the most part is the S&P 500.
All right, good deal. Well, good having you back. Good one to kick off with this year, and we'll see you here soon.
Sounds good.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.